Hey everyone, before we jump into today's numbers, just our usual quick reminder. This is for educational purposes, and it is definitely not financial advice. All investing comes with risk. All right, today we're diving into the DexFi protocol's health check for January 19th. And wow, the story today is really one of two extremes. On one hand, we've got a pretty significant correction in the fund's value, but on the other, the APR has just surged to a really compelling level. Yeah, let's just rip the Band-Aid off. The big number that's on everyone's mind is this one right here. The fund is down 14.5% from that recent all-time high. I mean, there's no denying it. It's a noticeable drop, and it's definitely deeper than the last one we analyzed. So, what do we make of this, right? Is this extended pullback a reason to start worrying? Or just maybe is it an opportunity hiding in plain sight for those who are paying close attention? Okay, let's get right into it. First things first, we need to look this pullback square in the eye and just acknowledge the raw numbers. So as of today, the fund's total value is sitting at just under $1.7 million. That's a drop of about $288,000, or that 14.5% from the peak we hit on January 14th. And it's important to be upfront about this. This is a more significant correction than the little dip we saw earlier in the month. But that is only half the story. Now we get to the other side of the coin, and this is where it gets really interesting, because you can see how the protocol's design automatically responds to a correction just like this. And boom, here it is. The APR has surged to an impressive 30.19%. Now, this isn't some random event. This is a direct, predictable result of the fund's value coming down. It's the system working exactly as designed. And to put that jump into perspective, at the fund's all-time high, the APR was a very healthy 25.5%. Today, it's over 30%. That is a massive increase in the potential yield being offered to bondholders right now. So how does this work? It's a really simple but powerful idea, an inverse relationship. See, the protocol keeps generating yield no matter what. When the total value of the fund goes down, that same amount of yield gets distributed over a smaller pot of money. The result? A higher percentage return for everyone involved. Let's translate this into real-world buying power. At the peak, $10,000 would have gotten you about 134 bonds. Today, with the bond price down around $64, that same $10,000 buys you nearly 157 bonds. That is 17% more bonding power for the exact same amount of cash. So, a crucial question is, what's driving this price action anyway? You know, the protocol doesn't operate in a bubble. It's closely connected to the broader crypto market. And really, this movement is strongly correlated with Ethereum. On January 14th, when the fund peaked, ETH was trading above $3,300. Today, it's closer to $3,220. That's a drop of about 4.2%. The fund's performance is, in large part, just a reflection of that. During this correction, what we've seen is that the fund has shown about 3 times the sensitivity to Ethereum's drop. ETH is down 4.2%. The fund is down 14.5%. This is expected. It's what a leveraged protocol is designed to do, amplify the market's movements. But, and this is so important, you have to remember that this leverage is a two-way street. When ETH recovers, we can expect a similarly amplified move to the upside. Now, let's zoom out and put all this into a longer-term context. It's so easy to get lost in the day-to-day moves, but the 40-day journey, well, it tells a much bigger story. Over the last 40 days, you can really see 3 distinct phases. First, there was that initial decline into late December. Then we had that epic rally of over 26% from the Christmas low to our new all-time high. And now we find ourselves in this third phase, an extended correction. So here's the crucial point. Even with this 14.5% drop, where are we really? Well, the fund is still up 4.2% over the full 40-day period. And maybe even more importantly, we are still a solid 8.2% above the low we saw back on Christmas Day. We've given back some of the gains, sure, but we haven't given them all back. Now, let's pop the hood and look at a couple of key health metrics. These tell us about user activity and conviction, and we'll start with trading volume. Trading volume follows a pretty predictable weekly pattern. You know, it takes a dip over the weekend. We saw that happen with a low of about 4.6 million on Sunday. But today, we're seeing a really healthy 74% recovery in volume, bringing it back up to nearly 8 million. This is a great sign that market activity is returning as we start the week. Now this is a really interesting sign of conviction from the community. Look at what's happening with the total bond count. Even as the price was falling from its all-time high, the number of bonds in circulation has actually increased. This is textbook accumulation. People are using the lower prices as an opportunity to mint more bonds and increase their stake. Okay, so we've looked at the pullback, the silver linings, the market correlation, and the on-chain health metrics. Let's bring it all together. What is the final verdict? Here's the balanced view. On the one hand, you've got the negatives, a 14.5% drop from the high, and yeah, it's deeper than the last correction. But on the other hand, the list of positives is just so compelling. The APR has soared to over 30%, bond prices are lower, which creates a better entry point. We're still well above that Christmas low, and volume is recovering nicely. And because of all that, our official health status is staying at yellow, signifying an extended correction. This acknowledges the reality of the price action, but it also highlights the underlying strength and the opportunity that this volatility has created. So to wrap this all up, is this an extended correction? Yes, it absolutely is. But look at what it's given us. An APR at over 30%, the highest we've seen in a while, lower bond prices, which means that same $10,000 now buys you 17% more bonds than it did just a few days ago. We're still positive over the last 40 days, and volume is coming back. So the question isn't whether this is a correction, it clearly is. The real question is, do you see it as a problem or an opportunity? The protocol is healthy, the yield is real, and believe it or not, the math for getting in is actually better now than it was at the all-time high. And that's our health check for today. As always, please remember this is all for educational purposes. It is not financial advice. All investments carry significant risk. So please always do your own research and never invest more than you're willing to lose. Thanks for tuning in.